Hi guys, I welcome you in this wonderful video. So we're going to be speaking about the issue of price action with synthetic indices. A lot of people have questions that should we apply pure price action with volatility indices, or should we just try to focus on indicators? So I just want to highlight some few important things. When it comes to price action, our main focus as traders, it is the behavior, or it is the transition of the price from one move or maybe from one wave to another. So that action or that transition, that's what we call price action. For an example, the movement of price from here all the way up to there, all that the thing that is happening here, it is price action. So if we analyze using price action, we are trying to understand and predict using whatever that is taking place here. And then in the case of whatever, that's where patterns come in. We don't just look at anything, we look at patterns. So the question is, does this market really behave in terms of patterns? Okay, I've been trading this market, I understand it very well, and what I can say is that its behavior is a little bit unique. The way the market behaves, it is a little bit unique, because I always highlight that this market is not moved by pure human psychology. It is not moved by that. So whatever that is happening here, it will not be linked to reality. I just want you to look at this market and then look at how this market is behaving in terms of the waves. You can see that there are transitions which are clearly, and you can spot and you can easily predict even the way the market is moving. You can see that there is usually patterns in every flow that you can see. You can be able to understand the strength, you can be able to understand the power, the direction, and you can be even able to identify candlestick patterns, waves, and whatever corrective move that is coming in. So you can see that this market is a little bit predictable. It is easy to analyze, but that doesn't mean that we should throw away this market. So what you should know as a trader is that when you trade a market, even when you're trading US 30, when you're trading Nasdaq, when you're trading DAX 30, your main goal or your main focus as a trader, it is to identify uniqueness. How is this market unique from what you know? If you know a market to be behaving in this way, in terms of clear transitions, clear patterns, then you should take that knowledge and say, okay, I bring that knowledge here. How does that knowledge relate to this kind of behavior? And then in that way, you'll be able to identify unique patterns which are suiting or which are belonging to this particular market. So if, for an example here, I always tell you that when we to see transitions in this market, usually the market, it doesn't transit that much. Usually when it turns and moves to a certain direction, it usually happens all of a sudden without us waiting. Even the waves, sometimes the waves are not formed by minor waves. For an example, you can see this wave here, there are no minor waves inside. It's just a series of green candles going all the way up. So you cannot even identify when strength is about to end, meaning it's hard for you to predict this. But then I introduced something which is called a flow break, understanding the flow of the market. And remember, on the other market, usually on the forex market, we usually identify the pattern, like the pattern that makes the corrective wave. For an example, a pattern is formed by highs and lows. So if we have lows and highs, then we're going to be able to identify a pattern. But sometimes we don't have that inside the corrective wave. Then that's who identify the flow. How was the market flowing all the way up? And then you take breakouts from that. So you identify the uniqueness of the market from the knowledge that you have. If you are a Fibonacci trader, you bring all your Fibonacci tools, you drag them, you drop them in the chart, you try to analyze and see how does the market behave in relation to what you know. So then you have to adjust your method to suit or to fit that particular market. That's why I say that if you don't understand market behavior, then you don't have to be trading that market, because the market is going to be above you, it will dominate you instead of you being in dominion. So understand market behavior, try to adjust and suit your method. So each market has its own unique behavior. So even when it comes to trading synthetic indices, try to identify how highs are formed, try to identify how trends are formed. And one other important thing, you need to know that here, whatever that is happening here in synthetic indices, the market behavior is not consistent. So that's why I always say, okay, it's better to scalp the market, guys. Why? Because the market behavior is not that consistent. You can have a trend, and all of a sudden, without signs of reversal, maybe you can have a trend reversing again, and you can have another trend without signs of reversal, you can have that trend reversing. For an example here, we were seeing this trend accumulating in terms of strength, but then all of a sudden, while the buyers were just becoming stronger, then from nowhere, without notice, the market started to collapse. So there isn't any consistent in market behavior. So for you to be profitable in this market, make sure that you, firstly, that's why I recommend scalping, because you can be able to detect short-term moves, because once you try to play long-term, you'll find yourself profiting and then losing those same profit. So understand the unique behavior of the market, analyze the highs, analyze the lows, analyze the waves, analyze the patterns uniquely to this particular market. So don't come, or if you come with knowledge from somewhere else, for an example from the currency market, come with that knowledge and adjust it to suit or to fit this market. So thank you guys for watching this video.